Today on GSC Grays Podcast, I'm joined by Greg Ricketts, Director and Farm Business Consultant at GSC Grays, to talk about the current economic and political climate in agriculture. Greg, we're obviously coming up to the budget, following on from a lot of change that's happened in agriculture with the tax changes that we know are coming in this April with inheritance tax and everything else. And it feels to me from the conversation we're having with clients that there's real polarization in the market of those that are optimistic and those that are pessimistic. What are we seeing on the ground, and sort of what's making people feel in either camp, I suppose?
Yeah, that's a good question. I think it is true that farmers seem to be falling either into the optimists or pessimists. And I think I'm not altogether sure that that's completely linked to the budget. Yes, there's an element of pessimism around that and the tax changes that are potentially coming in. And there are those that think there might be changes coming up in 26th of November, but perhaps we should just wait and see what's happening there. But maybe the fundamental reason why people are more optimistic, I think, is because their businesses are generally stronger, they're more profitable businesses, and they can actually see a more positive future for the direction of the business long term and for the family in the enterprises they're in. So I think, and maybe the area where the pessimism is probably arable sector, certainly at the moment. Obviously the pressure's on a bit, yields have been not very good, prices are low, but also in the more extensive areas where you've got higher dependency on support, and that support's been removed. So it probably depends what sectors you're in and how profitable your business is as to where you sit within either of those two camps.
So for those clients that are in the more pessimistic camp or having a harder time at the moment, what could they be looking to do to change their business and put themselves in a better footing?
I mean, the fundamental thing probably is to sit down. If the business is not working financially and not sufficiently profitable, then that means there's got to be some change. What that change might be will be different for each and every business. But if you take businesses where perhaps support has played a key role in the financial returns for the business, if that's not there, we've got to replace it somehow and try and find either a new enterprise, whether that's farming or non-farming, or expand and grow the enterprises that are on farm to look at trying to replace that lost income. And I think probably, again, getting sufficient critical mass in terms of turnover is quite key for businesses. Often the businesses that are struggling and the ones who are a bit more pessimistic don't have very high turnover. And if you have low turnover, there's just nothing left to cover all the costs of the business and generate a decent living. So I think focusing on taking a good hard look at where the business is at now, getting a good plan in place, trying to look at what enterprises could be expanded or grown on farm. Not always easy. If you're in the middle of a very rural location, it's not so easy to develop and diversify the business. If you're in an urban fringe area, it might be quite easy to sort of look at exploiting people and those kind of things to generate more income. But having a look at what you can do with your business, take a bit of control and try and find that plan forward.
And my experience of a lot of farmers is that they've gone into farming because they love farming, and the idea of diversifying into new enterprises, etc., is less appealing than maybe more farming or agricultural enterprises. Which enterprises would you say at the moment are the ones that people should be looking at and considering, and why?
Yep, in terms of the new enterprises, I think obviously this falls into farming and non-farming. Within the farming sector, I think there's no question about the poultry sector is doing quite well at the moment, broilers and free-range eggs. There are opportunities there for expansion growth or for new enterprises to be established. They can often sit quite well alongside another, an arable business would be quite well placed to go into those kind of enterprises. They're not without risk in terms of significant amount of capital. Planning is a real issue at the moment, and that can be just put a brake on those kind of opportunities. And if you look very long term, perhaps there's just signs that within a couple of years we might see capacity for free range hens being, we've got something like 6 million birds that are in cages at the moment, and if we're building at 2 million birds a year, 2-3 years time, we will meet capacity in that area. So I think you have to be mindful of where the direction of travel is in those sectors. But at the moment there's opportunities. There's opportunities in the beef sector with schemes that have come in, and there's some quite good opportunities. Again, might require investment in buildings, and obviously people have got to then invest in the cattle and stock, so funding is going to be quite a key requirement. But there's some poultry, B&B pigs, B&B cattle or some kind of cattle on a scheme. Those seem to be the farming enterprises that we're seeing the opportunities in at the moment.
And from the discussions that I think we've had internally, there's some quite interesting and quite long-term contracts available for people wanting to look into those sort of new enterprises. What sort of length contracts are available, and what sort of payback should people be hoping to be able to achieve?
Yeah, so if you take the poultry sector, and perhaps broilers would be a good example, there are reasonable premiums or enhancements on payments for a period of years, up to 10 years if you're building a new shed for broilers, with a payment per annum based on the square footage of the building, so much per square foot. And that's probably, it might not cover the whole cost of building, but could go 60 to 70% of the way to covering the cost of the investment over time. Mm-hmm. And I think if you're looking at payback periods, probably is around about 10 years after you take account of the income from the enterprise as well.
Taking a profit out
of it as well. Yeah. Mm-hmm. And then you're set up with a shed that would last 30 years or something like that. So there's, there's big investment, and there's, quite a significant period of payback before you generate real cash surpluses. But there are good returns there to be had.
Good. So farming business is looking to diversify or invest in new enterprises. What appetite are we seeing from the banks in terms of providing support and funding?
In many situations, banks are very keen to lend at the moment, but they're keen to lend to the right propositions. So if they've got concerns over the viability of something or the viability of the existing business, and somebody goes and is requesting funding for a new enterprise, and perhaps the business plan looks a little bit shaky, maybe not very well thought through, could be difficult to achieve funding. But for those businesses that have got good opportunity, if it's put together well, supported by a good business plan and budgets that demonstrate that it's got the potential to achieve what they think it has, and with the right security in place, the banks are keen to lend to. We've seen in the last few weeks 3 or 4 quite different and diverse lending requests that have come through, from a farm purchase on one hand to an investment in a poultry shed on another hand, in terms of another client situation. But the appetite is there, but it's for the right business venture, not for everything.
And from the bank's perspective, what level of borrowing are they willing to consider up to loan to value?
Yeah, typical loan to values are around about 60% loan to value for most banks. Occasionally you'll see up to 70%, but it's that typically of that sort of order.
And from a serviceability point of view, what sort of metrics are we seeing from the banks that they're hoping to achieve or see?
Yeah, in terms of payback and return and loans. I think, again, depends on the sector. If it's larger scale investments in buildings for pigs, poultry, or for beef cattle, you'd be typically talking probably 20-year loans. You would hope that would allow sufficient surplus after paying loans, that there would be a cash surplus as well within the business after meeting those costs of finance. But typical, I think the payback period would probably be 10, 12, 14 years, but you'd probably structure a loan over 20 years to allow a little bit of margin for risk and a bit of flexibility if the pressure comes on.
And from the discussions you've had with clients, Greg, are many looking to expand through taking on new tenancies, buying land, contract farming, share farming? What are you seeing in terms of appetite in the market?
I think it's probably fair to say that's cooled a little bit in certainly in my experience. I think if a block of land is offered, there'll be a queue of people line up and be keen to take that, as there always would be. But in terms of, if you look at the returns that people are generating from another block of land, versus perhaps what they could do if they invested in some buildings for a beef enterprise or for something else, actually a lot of people are probably questioning the investment in more land and rather favouring an enterprise that will generate a bigger return, maybe back at on the home farm, but they're adding to the resources of the farm, but also generating perhaps a more solid, robust income stream to cover costs for the longer term future. So I think, if anything, quite a few of my clients seem to be favouring those more intensive enterprises rather than just expanding over a bigger land area for the sake of growing a bigger area of cereals or grass for livestock.
As a business, we've been doing a lot of work looking at the cost of operations and cost of machinery. why are we particularly focusing on that as an area that we see as being so important at the moment?
I think one of the reasons we're focusing on the cost of machinery and cost of operation in that respect is partly because we feel there's quite a bit of opportunity to reduce cost. There's probably a bit of overcapacity within the industry as a whole. Probably, if you looked at it and you were really brutally honest, you could cover a larger area of farming with a smaller number of machines, as long as they're utilised effectively and operating at sort of optimum capacity. So I think we feel the opportunity there to reduce cost, and obviously the pressure's on a little bit. So there's a sort of dual need. There's a need to look at it, but there's also quite a bit of opportunity to get significant savings in that respect as well.
Thank you for watching. If you'd like any further information regarding any of the topics we've discussed today, please do get in contact with us.